Thank you, Tumi. Welcome, everyone. I'm here today to talk about Coronation's view on where we are seeing value, whether it's global versus domestic equity markets. Before we get into the detail, I wanted to just zoom out and take a broader view of how we specifically build and construct our multi-asset class portfolios and look at the four fundamental principles that are underlying the construction of these portfolios. Those four principles are on your screen at the moment and relate to being very active in asset allocation, being deliberate in instrument selection, using diversification to build robust portfolios, and then because we are a large asset manager, integration between our global and domestic research teams generally allow us to pick the best ideas across the geographies. I will relate these principles into our views on global and domestic markets specifically as we go forward. So this snapshot here is a reflection of how the Coronation Capital Plus Fund is positioned as at the end of September. Two key takeaways for you from here is that firstly, we are still maximum positioned in offshore assets, so 44% gross exposure in offshore assets, and the bulk of that is allocated towards global equity. And then the second key takeaway is that we have a relatively high weighting to equities, 62% of the portfolio in both global and local equities. So let's start off with the equity exposure. And I wanted to demonstrate to you that principle of active asset allocation as it relates to both South African and global equity exposure in the fund over time and how that's changed over time. So this shows you the fund exposures from 2001. So you can see how that's changed over the last 23 years. And you can see generally the trend has been for an increasing allocation to global equities. Now, partly this has been driven by our increased allowance in offshore assets, but I do want to highlight that even with that increased offshore allowance, our fundamental principle for us deciding between local and global is always valuation-based. So we will not be driven by an allowance or offshore regulation in terms of our exposure. And over those last 20-odd years, we have switched between local and global equities depending on where the valuations are most attractive. So in 2013, when South African equities got very expensive, we reduced our South African equity exposure and increased our global equity exposure. In COVID again, when there was a global sell-off on all asset classes, we chose to increase our exposure to SA equity. So you can see the dark blue line post 2020 increasing quite substantially. And then the more recent change in asset allocation was with the increased allowance with the Reg 28 changes. And coupled with that, seeing the big drawdown in global equity valuations in 2022 when we switched out of South African equity and back into global equity. So once again, just a reminder, we are very active in asset allocation, and those asset allocation decisions will be driven by where we are finding the best value. So let's talk about South African equities, and I think we can't talk about South African equities without acknowledging that the outlook has become far more positive post the market-friendly coalition government that's formed post-elections. The impact of that and our outlook for South African equities from here on forward is, I think we're quite confident that we are going to see a short-term cyclical upswing, especially with regards to the consumer. The consumer is going to have a lot more money available in their pocket. That's going to come from lower interest rates, a stronger rand, lower inflation. That's going to physically put more money in their pocket. And then, of course, because they are now generally having a lot more consumer confidence because of improved performance from Eskom, the positive election outcome, I think that they will be willing to spend that money, and you should see a boost in consumption expenditure, which should support GDP growth. Business confidence, we've also seen a more recent uptick in business confidence, and usually what we see is that investment starts to follow on as business confidence picks up. So we expect that in the short to medium term, you should see GDP growth recover to around the 2% level, off a very short base. The question for us is that longer term, will the cyclical upswing translate into a structural uplift and into GDP growth? Specifically, will GDP growth be materially higher than 2% levels, and can it sustain there? We are a little bit more cautious on this longer term outlook. I think it's fair to say that 3 decades of underinvestment in infrastructure cannot be fixed overnight. Yes, Eskom is on the path to repair, especially in terms of generation, but we need to see the investment in transmission coming through. Fixing Transnet is critical, and here again, you'll need to see support for their balance sheet come through so that they can access capex to fix the rail and port infrastructure that has been so underinvested in. The implication of our more cautious longer-term outlook is not just for our equity selection, but also has implications for the way we're positioned in our fixed income carve-out. I think the reality of GDP growth being sustained at 2% levels, which is our base case expectation, still means that the long-term fiscal outlook remains concerning. So we remain cautious on the fixed income despite the very healthy real yields on offer, and I'll show you later how we are complementing our SA fixed income with the offshore allocation to try and build a more robust yielding portfolio for clients. So if we couple that more positive outlook for SA equities with valuations, what we see here is that SA equities actually still look very cheap, especially when compared to global markets. So I've shown you here the MSCI SA Market Index versus Emerging Market Index, as well as the MSCI World Index on a 12-month forward PE ratio basis. Very long-term graph. You can see how we've derated so substantially, and even with the rally in SA equity markets that we've seen more recently, we are still looking cheap from a long-term perspective. Another data point here, just confirming that view that our SA equity market is cheap, is our own internal assessment of upside to fair values. Again, a long-term graph from September 2009 to today, showing you that the upside to fair value has come in from 6 to 12 months ago. So there was definitely more value in SA equities a year ago, and the re-rating has taken some of that upside away. But still, 30% upside to fair value is not to be laughed at. And then the second point I want to make is that this upside to fair value pretty much bakes in a muted GDP growth outlook. If South Africa manages to pull itself up to higher GDP growth levels, you would expect that upside to fair value to be a lot higher. So good value in SA equities. And just a summary of how we positioned in our portfolios, as I said before, because we're still very cautious on the longer term sustainability of GDP growth in the country, we are still, the majority of our SA equity positioning, exposed to global stocks that happen to be locally listed, and I've named a handful of stocks there. Our resources weighting is pretty light. I think we have to acknowledge that China's economy is under pressure, so demand from China is likely to be muted. And some specific commodities like PGMs and oils will face longer-term headwinds in terms of demand. On the domestic side, we have a very meaningful position in banks. Outside of the banks, we've been very defensively positioning our money in food retailers, pharma retailers, and select education stocks. We are, in the domestic space, continuing to be focused on businesses that can grow market share and grow their earnings, even in a muted GDP growth environment. Now let's move on to global equities. And I think here the picture is slightly different, especially from a headline indice level. Headline indices have been very strong in terms of returns over the last 10 to 20 years. The MSCI ACWI is up 2 times over the last 10 years. And because of such a strong starting point, we think that returns are going to be far more moderate in the coming decade from global equities. Now, having said that, you would have noticed in the slide that I showed you earlier that a pretty large portion of our fund, 34%, is allocated to global equities. Now, given that outlook, why do we have a large allocation to global equities? The reason is that we think that there is a breadth of opportunity in those indices because the index returns have been very concentrated. And you've probably heard that before. The US market has been extremely strong, and there have been a handful of stocks in the US market that have driven those returns. Outside of those magnificent 7 stocks, we see a wide range of sectors and companies that we think have deep intrinsic value still left. Outside of those 7 stocks, we see a wide selection of stocks that actually Outside of those 7 stocks, we see a wide selection of stocks that we think can still deliver significant value for clients going forward. So we believe the opportunity exists to deliver strong alpha from good stock picking. Now, why have markets been so concentrated and been so inefficient? These are a couple of the reasons we think are driving that inefficiency. The first and key reason is passive funds under management now have become a bigger player in markets. Those passive funds are very mechanistic in how they invest. Rarely are they fundamentally driven or valuation driven. And we can see the rebalancing of these index and the impact on markets and share prices as they rebalance every quarter. The second big reason is just the larger participation of quantitative traders and algorithmic traders with far shorter time horizons and who are far more news flow driven. This does impact volatility in the market. It does create the inefficiencies we talked about earlier, but at the same time, it also creates very material stock picking opportunities and gives a manager like us the ability to significantly outperform headline indices over long periods of time. Very similar graph to what I showed you on the SA equity basket earlier on. This is our internal assessment of fair value upside in the global equity space compared to share prices. Again, over a long-term graph and showing very healthy upside to fair value at 45% plus in the global equity space. Just a related point here, that 45% upside to fair value compares to this 30% upside to fair value we're seeing in SA. So global equity is actually showing you a far bigger value opportunity than SA equities. Bringing it back to our exposures in the fund, you can see here a wide selection of sectors and companies reflecting that breadth of value that I talked about earlier. And the other important point here to make is that South African investors do not get this exposure in the South African equity market. Exposure to software companies, to payments companies, to food delivery companies. These are just simply not available in our SA equity market. And what it means is when we construct our multi-asset class portfolios, these exposures allows us to have different drivers for our equity returns. It helps us build a more robust equity building block. Bringing the point home on diversification for another asset class, this is our discussion on global credit, which we added to the portfolio in a significant manner in 2022 and early 23 when we saw yields and credit spreads blowing out. For a long time before that, we simply did not hold any global fixed income instruments. The yields on offer were not attractive. But in 2022 and 2023, when we started seeing healthy real yields in that space, we stepped into this category and it has delivered good returns for clients. We currently have a 9% weighting in global corporate credit. Yes, the yields have come in, the credit spreads have compressed, but we're still getting a 6% hard currency yield on global credit. And we think this is a nice complementary building block to our SA fixed income. It helps us diversify counterparty risk and in the offshore space versus the SA space. So summing it all up, I think I'm going to repeat some of the points I said earlier. We have maximum offshore exposure in the fund. We are trying to also protect and preserve clients' capital. So the 44% gross exposure has a currency lock against a portion of it. So we are 37% net offshore exposure. We have a relatively high weight in equities, and as I've discussed, we think there's stock picking opportunities in global and South African equities. Our bond exposure, we think, has a healthy real yield underpin with the SA fixed income allocation, complemented by the global corporate credit, and then low cash because we fully invested in all those asset classes. We think those principles of being active in asset allocation and deliberate with instrument selection have delivered for clients over the longer term. The Coronation Capital Plus Fund has had very strong returns ahead of their target over most time periods. And looking at it today with our current asset allocation and instrument selection, we're confident that we can deliver on our target returns going forward. I'll hand back to Tumi. Thank you.